Most of the time in IPOs, you would end up paying little higher than if it were listed for some time. That's my gut over a period of time, because that's where they fail also eventually, correct? In my own career, I have bought which were 12, 13 P. Today they are trading at 40 P. At that point in time, they were classified as basically cheap, not even GAAP. Typically a combination of highest valuation, highest profitability margins, highest growth, highest ownership. That's the combination where you start drawing the line.
वेलकम एवरीवन वंस अगेन टू मिंटेड सीरीज। दोस्तों, आज का एपिसोड थोड़ा अलग है और आज के गेस्ट बहुत खास हैं। इसलिए नहीं कि वो किसी बड़े फंड हाउस के सीआईओ है, बल्कि इसलिए क्योंकि इनकी सोच बहुत अलग है। मिस्टर श्रीदत्ता बंदवलदार, सीआईओ इक्विटीज कैनरा रोबेको एसेट मैनेजमेंट कंपनी। He was associated with Motilal Oswal, MF Global, Heritage Capital, SBI Pension Fund। ये एक ऐसी जर्नी है जहां हर रोल ने इन्हें मार्केट का एक नया एंगल दिखाया। जुलाई 2016 में कैनरा रोबेको ज्वाइन किया और तब से आज तक सिर्फ एक फिलॉसफी पे काम किया है, सिलेक्टिव क्वालिटी स्टॉक्स, मीडियम टर्म कंपाउंडिंग और अननेसेसरी शोर से दूर रहना। आज ये 1 लाख करोड़ से ज्यादा का इक्विटी एवं मैनेज कर रहे हैं, लेकिन जो चीज इन्हें बाकी से अलग करती है वो नंबर नहीं, वो प्रोसेस है। आज हम उसी प्रोसेस को खोल के देखेंगे, क्या गलतियां, क्या कन्विक्शन, और वो एक सवाल जो हर इन्वेस्टर को पूछना चाहिए स्टॉक खरीदने से पहले। वेलकम सर, वेलकम टू मिंटेड सीरीज।
Thank you, Aniket. Thank you so much for having us on the show. It seems that the way you have put it, the questions would be very, very interesting.
Yes. So let's start with our first question and let's understand about you, how you came into this industry. I have heard that from engineering, you came to investment analyst desk, and then for that journey to CIO. How was it?
No, I think the journey has been very, very fulfilling. Not that you start any journey with the target in mind, but I was lucky enough to get a lot of opportunities, which actually took me where I am. Of course, I started with engineering, which I did in the city of Chhatrapati Sambhajinagar now, which was erstwhile Aurangabad in Maharashtra. Then I did my MBA, and during the MBA, I actually took a little bit of an interest. Before that, I had no clue about the stock market. I started taking interest in first with the macroeconomics, and then gradually I developed interest in basically understanding how businesses and managements effectively over a period can actually create a lot of wealth, and even average people like us, by betting on some other smart people and smart businesses can make money. And that's where the journey started. I did institutional equity research with MF Global and Motilal Oswal for 4-5 years. After that, I have worked with a hedge fund, which was long short hedge fund. Then I worked with a pension fund, SBI Pension. And then last 10 years has been a great journey at Canara Robeco. So that has been largely a sum and substance of the journey. But as I always say, a lot of luck. A lot of people start with the journey. They reach at different point in time, different places. I've been lucky enough to actually reach a good place over 10 years, 15 years.
So it is about you picked up right thing at the right age, actually.
Yeah, some of those choices probably were right. So fundamentally, the choices have always been clear and they're still the same. Skill sets over anything else at any given point in time, because in this business or any business, I think that's the starting point that leads to opportunities for anybody, not for particularly for me or anybody, but it's true for every individual who's actually professionally working or even doing businesses, because if they try to monetize everything upfront, I think it doesn't play out very well for most of the people.
My another question is basically, when you people choose stocks, you look at business quality, management quality, balance sheet quality.
Mm-hmm.
What do you think in तीनों में से सबसे difficult क्या judge करना होता है?
I don't think the fundamental, this, of course, I mean, in everything there's a science and art. Okay. So science part, if done well, I don't then think that is a very, very difficult part. It is well established. This is an old industry. For 50 years, basically, a lot of great investors have taught how to actually evaluate some of these things. Of course, for every, and I'm representing Canara Robeco, so every house has to actually have its own process. So I think the science part of it is not a difficulty. The art part of it is, of course, a difficulty, because a lot of times there are IPOs, there are companies who don't have who don't have enough of history. There are companies where the second, third generation comes and it seems like things are changing and they don't change sometimes. So all those things are involved. I don't think that fundamental aspect is that difficult if done well. But it is like anything else in life. If you don't have that basic ingredient of initial hard work and diligence in place when you actually go through the universe inclusion. So we have roughly 400 companies in our universe, and every company has gone through this process of evaluation of business quality and management quality. One thing is to say it, and second thing is actually really to go and take that pain initially to go through all the science aspects of it. Arts is, of course, that's judgment sometimes, but that basic technical factors can be done. Yes, what we have seen is that it is not difficult, but monitoring sometimes is a challenge, or whether it is business quality or management quality over a period of time. The sector dynamics can change, so economics of businesses can change. So something which was great can become average, and something average can become bad, and something which was very average can become good over a period of time. So it's not only actually a one-time exercise. It's like evaluation of business is also kind of continuous process. For example, with the kind of disruption that you are having on the distribution platform through the democratization of distribution. Now the entire consumer space has changed from where it was 10, 15 years back. So 15 years back, if you have felt that this X business is great, probably today it is good, but it is not great anymore because there are 5 guys who are coming and competing. So I think those changes or evolution and how that evolution happens, monitoring that is very, very critical, not to miss out on factor that something that you thought was great business and management over a 5-year period for business because of competitive dynamics, for technology changes, for regulatory changes, or on management side because of incremental capital allocation, they can undergo a shift in terms of where you will put them if you were to evaluate them today versus 5 years back. So I think that monitoring is equally important. That's how I would put it, rather than understanding everything at a point in time.
Just related to your answer, I just wanted to understand, sir, in last 5 years, we have seen market volatility, one side upside market. How did you deal with an IPOs that came within that period?
So I think for us, IPOs generally as Canara Robeco, our participation rate is significantly below averages as far as AMCs are concerned, despite us now we are a sizable house. Fundamentally because, again, our belief is the management and investment bankers know more about the company. So seller knows far more about the company than the buyer. So you would typically tend to venture only where you feel that there is a clear-cut, differentiated business that is at offer. Because invariably, most of the time in IPOs, you would end up paying little higher than if it were listed for some time. That's my gut over a period of time, because that's where they fail also eventually, correct? Also about business detailing aspects, your understanding is always limited, and that's where our approach has been, you either buy something, because even in this one-way market, there has been volatility. So there have been IPOs which have come during the tougher period of the market, and they have generally done better than basically the ones which came during the extreme bullish phase of the market. That's one. Or second, there are businesses where just sheer perspective of kind of profit pools that they can generate over a period of time, you want to actually have participation in those businesses, because anyways the allocations are limited. But once you start at some stage, your learning is quicker in those businesses. So those are the objectives with which we work. But typically, we have been basically kind of our participation has been very, very limited in terms of IPOs.
Okay, got it. So every fund manager says that they buy quality businesses or then long-term investment करने के लिए they buy quality business and they stay into it for a long term, right? आपकी इन्वेस्टमेंट प्रोसेस में ऐसी कौन सी चीज है जो आपको लगता है कि बाकी लोग शायद उतना नहीं करते?
So I can't talk about others in terms of investment processes and how theirs is different than us. I wouldn't know that in detail. I think the better way to look at is you look at the outcomes. Where does it manifest in terms of any investment process? Whichever that investment process is, I am not saying something is good or bad in terms of the outcomes. So basically, when we say, for example, and we don't say it specifically, but we try to focus on as public money managers as much as possible within the limits as business quality and management quality, which is acceptable, balance sheet quality, which is acceptable. It reflects in two things, in my view, because the only way to judge this one asset manager, one fund manager versus other is how's their churn, the two parameters that you said. So in churn, it reflects very well how your holding periods are. Second is, of course, how many companies you have been holding as a AMC over a longer period where you had some kind of accidents. Every AMC will have some of the other accident, but how many accidents you had? Because when you are dealing with a risk asset class, of course, you will also make mistakes. But these are the two parameters where clearly I think what we say and what we do reflects fairly well. Thankfully, we hadn't had any significant equity security accidents. So we have not been present in any of the issues where there were significant issues. So that's one which tells you about how diligently or how closely we follow our own process around quality of business management and balance sheet. Second is, of course, your holding periods, which reflect in churn, where again we score basically very, very well. Our churns would be probably again one of the lowest in the industry. So combination of these two things actually tell you that we largely do what we say. It might not be 100%, but to the best of practical possibilities, it is done. Just to extend it, but we don't have any specific, while I told you about, we don't have specific view about churns. I think if there are more opportunities, if I can ideate more, and even if my churn is double, I don't think it matters. As long as we can create alpha for investors by churning. And for churning, of course, you need so many ideas which are doing well, which means incrementally. If that is there, then we are agnostic to. So I just added that because it shouldn't be that necessarily construed as churn as the input. Churn is an outcome of the fund management activity rather than input for us.
What philosophy you prefer more? GARP, growth at reasonable price, or buy at any price?
No, I think it's never that black and white. I mean, for anybody and not for us also. We tend to look at basically growth at a reasonable intrinsic price rather than intrinsic valuation, rather than growth at reasonable price or growth at any price. We're agnostic to it because most of the time when people talk about price or valuations, they typically tend to focus on statistical valuation part of the equation. We want to keep ourselves little away from that statistical valuation part. We want to focus on intrinsic valuation, whereby I'm okay to buy a 5p stocks and I'm okay to buy a 100p stock as long as the incremental opportunities, longevity of earnings growth, capital efficiency of the business, ability of management to actually execute that is in place. I'm willing to pay higher. I'm also willing to pay higher, buy lower, not for statistical valuation, but if something is fundamentally changing in that sector. And the classical examples over last 5 years for us has been, and for us, because we are classified as little growth quality, it's important to tell the investors that we bought aviation, hospitals, hotels, telecom, some of the erstwhile corporate banks, all after between 20 and 22, because fundamentally, cyclically, or structurally, things change. Some places is competitive intensity changed. Some places the business capital intensity changed. So they become capital light. Some businesses where basically the inherent risk of credit cost went away. So fundamentally, you would buy a cheaper valuation business or a higher valuation business. Higher valuation business, if the longevity of earnings growth and capital efficiency is placed and you think that the management can keep executing it and the profitability matrices are not yet established fully. So that 100 is not 100 but 25 in most of the cases. And you are willing to buy a 5 or 10 PE stock if you feel that, okay, historically there has been challenges in terms of whether it is competitive intensity, it is just capex that they did in the last cycle, it's credit cost, it can be the capital efficiency, any of these things changing, then that 10p will also re-rate to 20p. Because a lot of these arguments around whether it is GARP value, it is at any price, these are all more like classifying things into black and white, whereas when we do things, most of the time they are gray, because there are enough businesses in my own career I have bought which were 12, 13p. Today they are trading at 40p. At that point in time, they were classified as basically cheap, not even GARP. Okay, today people classify them as growth quality. So, and there are enough companies which were 25, 30p, which have gone to 15p. So it's far more nuanced and far more actually bottom up and far more sometimes contextual also, because sectors go through growth phases. When they are in growth phases, they will be treated very, very differently in terms of how they are valued. If the growth assumptions change, if the capital assumption change, then they again will be treated very, very differently. So it's not like you can classify them, but fundamentally we focus on, basically try to focus on growth oriented businesses where, as far as possible, where basically the management business quality is acceptable, balance sheet quality is acceptable, and then intrinsically the valuation, and I'm not talking about statistical valuation, but the intrinsic valuation, if I do the DCF of that company, it is around fair value. So that's what the attempt is. And why I said DCF is because DCF is the best way to understand, because your assessment about the future cash flow and my assessment about the future cash flow, if it's different by 3x, then I would value the company very, very differently. I would look at the same PE very, very differently than you. And that's where that intrinsic valuation is more important than just actually looking at it on statistical valuation. That's how we look at it. It is a little more nuanced than how you're thinking.
Suppose if you like some specific company, and if it is very expensive, not very expensive, but expensive in terms of the valuations part, how can you draw a line for it? एंड आपके करियर में कभी ऐसा हुआ है कि ओवर द पीरियड ऑफ टाइम इस लाइन को जो ड्रॉ करने का जो पॉसिबिलिटीज है इसमें कहीं चेंजेस आए? इफ यू लाइक सम कंपनी,
again, like what I said in previous question, there is no black and white. Okay, it is far more nuanced. Typically a combination of highest valuation, highest profitability margins, highest growth, highest ownership, that's the combination where you start drawing the line in terms of trimming your position. Typically our style is actually to start trim rather than exit, because invariably 7 out of 10 times which are trading at a very, very high valuation, inherently they are good businesses. Like today industrials are trading, some of the industrials are trading at high valuation. The question is not whether they are good businesses or not. They are good business, that's why they are there. But are they at the highest growth rates, possibly cyclically? Are they at the highest margins? Are they at the highest ownership from investors' perspective? If all that combination is there, then typically you would want to trim it. So that's the basically typical drawing of line for us as far as the expensive stocks are concerned, because there have been enough companies which kept delivering 25-30% growth for very, very long period of time, and you got out of them very, very early. So it's both ways. It cuts both ways. So beyond a point, it also becomes, along with science, it also becomes a little bit of a judgment in terms of how do you see basically the growth longevity sustaining in a particular business at what scale without inviting competition. And that's where it starts becoming a little more judgment at point in time, at a beyond a particular valuation, beyond a particular returns in stocks when they become expensive. So typically our reaction is, wherever you feel that the combination is high growth, high valuations, high margins, and high ownership, then you start basically thinking that the market is not leaving much of a margin of safety. So it is better to start actually trimming gradually.
Now, suppose if you have a strong conviction on some stock, suppose, and if that stocks get corrected by 25, 12, 30%, right? So how would you judge it as कि ये market की गलती थी या हमारे thesis की गलती थी?
No, I think it's fairly simple, psychologically very difficult, but from a, I think, core perspective, it is simple, because if it is correction along with the market, and if the underlying earnings thesis of the company has not changed, then I think it's a very, very binary decision that you just go and buy, because you know that it is more system correction along with it has corrected. But whenever it's relative, correct? For us, it is relative. For everybody, it is relative in terms of outcomes. So the moment market comes back, this company has a much, much higher chances of coming back because its earnings thesis is in place. So this is probably relatively the easiest decision for somebody who's bottom up in terms of adding to the name. Of course, you have to reevaluate your thesis that along with market correction, has there anything changed in your thesis which was there 3-6 months back versus today? Has the stock corrected along with the market, or has stock corrected independently? If stock has corrected independently, then you go back and on drawing board and check whether your thesis is getting tested, because naturally the stock will not correct 30% without market correcting 15-20% if something in the earnings thesis is not broken most of the time.
So Canara Robeco के जो funds हैं, that is basically high conviction investing funds से जाने जाते हैं, right? What if conviction based investing का सबसे बड़ा, I want to understand that conviction based investing का सबसे बड़ा downside क्या है जो investors अक्सर समझ नहीं पाते?
No, I don't think conviction is the right word. We are far more process oriented. We are far more driven by bottom up earnings growth. That is a better description for us as a house. we're fairly diversified. We control the risk. Of course, the risk of higher conviction or higher basically confidence is sometimes you can have higher concentration, and we avoid that higher concentration through our risk practices, whereby the active weights of particularly illiquid securities, which is mid cap and small cap across our portfolios, is controlled. So there are checks and balances which you have put in place, whereby the kind of active weights that you can take in a small cap or a mid cap in each of the fund is restricted in terms of individual securities. And that's a good risk parameter to put in place, because in large cap, even if you go wrong, there is enough liquidity to course correct. But in small cap, mid cap, you can have liquidity challenges. And that's where we have put in this place, things in place that on one side, where you have conviction on the underlying earnings growth, your bottom up, you're far more convinced, okay, earnings will play out. But how do you know, don't go overboard? You don't go overboard if you control the weights in terms of the portfolio construction. And that's where we actually manage that risk.
So what are that 3 picks that you are proud of and 3 of your costly mistakes?
Oh, I wouldn't actually talk about the stocks individually. I would tell you the traits. Those names, I think when we avoid taking names, I don't think it helps. Okay. I think the biggest mistake is actually selling your large winners early sometimes. While we don't do that, but there are 1 or 2 places where I have done that. And those stocks, for us, they were 20, 30 baggers, and they went on to become another 30 times or 20 times. So it's like 60 bagger, out of which you got out halfway out of over a 10-year journey. Yeah. So I think that's the biggest mistakes, because nobody counts it because it doesn't get reflected in the actual numbers, but is the compounding or large compounding that you missed out in some of the names. So I think those are clearly the biggest mistakes. In fact, our success has also been the same. Basically, a lot of names, when I say our churns are low, there are enough and more names which we have been holding for 3 years, 5 years, 7 years, 10 years. And the companies have become 3 times, 5 times, 10 times, 20 times, 40 times 1 or 2 of the companies over 10 years. And that's also a strength. So as a trait, I think you have to be the learning is you have to be probably the biggest factors which affect your outcomes is the biggest winners. Because a loser can never, with our process, a loser hopefully will never lose you more than 20, 30, 40%. But a winner can lose you 200, 500, 1000% if you get out too early. So I think that's around, for me, the key learning, or generally around winner losers. That's the core thing to focus on for us. And that's what I think my learning is over the last 10 years.
Mid caps and small caps in last few years have seen a great upside in the market and a correction part also. Right? Do you think आज के टाइम पर आपको लगता है कि वो फ्रॉथ खत्म हो चुका है, या फिर still there is something that we can expect?
I think it is clearly not like 24. Let me put it this way. In 24, there was clearly disproportionate amount of exuberance that market was displaying. And the froth was in a sense that everybody thought what happened between 20 to 24 was their birthright of 20-25% CAGR return. So people were pumping in money. The valuations were high, and just sheer valuations, again, like coming back to the first question that you asked, sheer statistical valuation high was not a problem, because the stocks were going up. Generally, the consensus was building in higher and higher numbers in the future projected numbers for 25 and 26. So your valuations were, even if you look at today, the same valuations, they were even more expensive than what they were, because the earnings did not play out that way. So ownership, valuations, earnings expectation, or that combination was inequal. I think today, it is far more benign. 2 years have passed. Not much returns have been made. The 5-year, 3-year returns are actually coming back to the long-term averages of India. The earnings estimates built in today, even in small cap, mid cap, are relatively more reasonable. More reasonable in small cap than mid cap, but fairly reasonable. Large cap generally is efficient because there are a lot of guys covering it. There is a lot of information available. But today, when I look at it, probably large cap valuations are in a fair to cheaper zone. Small cap valuations, while statistically are still expensive than history, the earnings expectations are not building in any exuberance, so they are also okay. Mid cap is where the valuations are high. Now earnings are actually still relatively higher built up. So fair valuation perspective, it will be large cap, small cap, and then mid cap in terms of how they are stacked today. And mid cap are that way just because of the combination of what kind of businesses or sectors are represented in those 150 stocks, which is all industrials, T&D players, cable players, hotels, hospitals. And it's just a little bit of a technical, because of which their valuations and their earnings estimates and their valuation, everything is high. So that's the way we are looking at it.
So do you think that is there any big structural change in Indian economy which is not yet priced in?
I think two things. I'm not so sure whether it is not priced in. I think it's priced in to some degree, because large caps have their own challenges because of IT and probably consumption, some FMCG and all. But as far as broader market is concerned, it is fairly priced in. But the two things that have changed clearly is basically, one is the cost of capital in the country has been coming down, because whether it is government, RBI, both of them have in tandem run processes which will do supply side reforms, which will not run high fiscal and current account deficit. And that's where our inflation is in control, barring this latest war related stuff. Period. So sustained lower inflation of, say, hypothetically, say 3-4% versus 6-7%, which we used to run, means your cost of capital is low. A lower cost of capital also means higher valuation structurally. That's what you're seeing in India also. I mean, to some degree, particularly in the part of the market where FIs are not seller or there is no large seller. So that's one thing which is reflected, of course, clearly, because mid cap, small cap are trading at 22 to 25 times 1 year forward versus where they used to trade in last decade. Part of it is earnings, part of it is cost of capital. Second is, I think, linked, which is supply side reform. So this government has been focused on macroeconomic stability and supply side reforms, and that's reflecting in some of these parameters. So those are the two things that have changed. But I think it's, to a great degree, it is fairly well represented in the valuations, at least.
What kind of impact we can expect on Indian markets for the damage which has been done already in the US-Iran war?
I see. It's nobody knows whether it is going to stop immediately or not. As of now, it is looking like it is stopped. Our base case is that it will not incrementally at least impact the oil prices. See, because our concern is more not whether they are fighting or not. Our concern is, if the Israel-Iran fights, probably the oil prices will not go up so much. But US got involved, so energy prices were up, and that's our concern. If the energy prices stay where it is now, today it was $78, $79. I think largely it is a 1 or 2 quarter impact in terms of numbers. Beyond that, there will be no significant impact in numbers. So our earnings growth recovery, which has started 1 or 2 quarters back gradually, I think that should continue.
Can we expect something, a big impact into our consumption kind of sectors?
So intermittent impact would be there, not on consumption necessarily, but margins of some of the sectors, because everybody uses energy as a input, different industry to different scale, FMCG, cement, metal prices have been up, aluminum prices was up because energy prices is up. So basically, predominant part of Indian listed space is commodity users, whether it is energy directly or indirectly energy. And so to that extent, the operating margins will suffer for a quarter or two, so earnings will get downgraded. But since market always discounts the next 12 months, 24 months. So if the event is behind, then market will not ignore the numbers that are going to come in first quarter or second quarter to some degree, if the incremental things are improving.
So this question is very important for my viewers. Basically, why Canara Robeco Mutual Fund out of all 40-50 AMCs? Why should opt?
I think 3-4 things. First is, most of the people don't know, but this is the second oldest mutual fund by Canara on one side, and Robeco, which is the investment firm, on the other side. The point is not it is second oldest. The point is we have enough number of schemes which have seen multiple cycles. Probably there are a lot of AMCs who have not seen even one cycle today.
That is important.
So that's very critical, that through cycle we have managed money. Second is basically the point that we always focus on, as far as possible, risk adjusted return. So there is equal focus on downside protection along with alpha creation. So focusing on through cycle rolling returns versus taking disproportionate risk and generating returns for a cycle or 2 years, 1 year. I think that's avoided through the process. Third is, of course, our investment process, which the proof of the pudding of which is that, as earlier I said, there haven't had been any accidents, and still the outcomes have been. It's like you're trying to take as less a risk as possible and trying to generate as much of alpha that is possible through cycle, because nobody tries to divide the returns by standard deviation or trying to calculate risk adjusted. So I think those are the 3-4 things: through cycle track record of multiple schemes, alpha creation along with the risk focus, downside focus. Third, a very, very strong investment process. And fourth is, of course, an investment process to which a very strong investment team is backing. So we are a 20 people strong investment team covering 400 stocks. Every fund manager has average experience of upwards of 13, 14, 15 years. Every analyst on an average has more experience than 6, 7 years. So that's a combination. Strong team, strong process, and a track record which is around for several schemes, which is running into 10, 15, 20 years. So I think those are the reasons why one should look at Canara Robeco independently, irrespective of what other AMCs are there or not.
So my last question basically is for young investors. Suppose if there is a young investor between the age of 25 to 27 and he wants to start his wealth creation journey, what advice you will give to him?
I think just stay focused that you can't produce miracles overnight. So just focus on giving time to market, stay put in market for longer period. Typically, the largest benefits, whether it is SIP or otherwise, people have seen after 5-6 years of investing, because invariably investors come at when there is activity in market rather than when the market is passive or market is subdued. So I think giving time to compounding. First, for that to start with savings, because at young age, typically there is more proclivity to spend rather than save. Because unless you save, you are not going to invest. If you don't invest for longer periods, you are not going to compound. If you don't do that, it's not going to be a sizable wealth creation. Returns can be anything. Allocation is more important, and that allocation only happens when you save and start doing allocation at a pretty early age and hold on to those allocations. Second is, of course, once you get a little bit of a confidence, using the opportunities in market every third, fourth, fifth year in market, what I've seen is you typically get a large opportunity. At least once in 7-8 years, you get a very, very large opportunity. By that time, you should have actually behaviorally adjusted yourself to do a sizable investment at that point in time. I think that enhances your actually basically both allocation as well as the IRRs over a period of time. So I think those are the two things which are critical, which is very, very application oriented. I didn't went into theory, but these are the application oriented stuff that people can do. And last, if I have to add, probably don't chase the trends because they don't survive most of the time. Like just 6 months back, there was a huge trend of precious metals. Now nobody's talking about it. Before that, at some point in time, it was IT and commodities. It did not sunset. Today it is AI, so it will also not sustain. Not that any of these underlying asset classes or commodities has problem. It is the investors who create problems. So don't chase trends and invest on the wrong side of the cycle or allocate too much on the wrong side of the cycle. Right. Those are the three things which are critical.
Great, sir. Great. ये था आज का एपिसोड, और सच कहूं तो आज के कन्वर्सेशन ने कुछ चीजें क्लियरली समझाई जो बहुत लोग कंफ्यूज करते हैं. क्वालिटी, कन्विक्शन और पेशेंस, ये 3 वर्ड्स लगभग हर बड़े फंड मैनेजर कहते हैं, लेकिन आज हमने देखा कि इनके पीछे एक्चुअली क्या होता है, कैसे गलतियां होती हैं, कैसे थीसिस टेस्ट होती है, और कैसे एक CIO सोच के पैसा लगाते हैं, ना कि फील करते. Thank you so much, sir. This is really very insightful session for us. Thanks for joining us.